Morgan Stanley expects the REIT rally to continue next year as they historically rise following a Fed pause. The firm's also bullish on open-air shopping centers. They're actually downgrading Simon Property Group to equal weight and upgrading Recency to overweight. But there's one REIT our next guest has been particularly keen on, and that's Welltower, our mystery chart from earlier. Shares are up 30% 36% this year, and 10% since he was on with us in late October. Joining us for more is Ron Kamdem. He's head of U.S. REITs and commercial real estate research at Morgan Stanley. You made it, Ron. We made it to almost year end, and it was a nail biter at times.
Great to be here. Thanks for having me.
So is Welltower a position you now want to move away from, move more to equal weight? What are your thoughts on it?
Yeah, we think that Welltower still has room to run, and it's very well positioned as you're going into 2024. The key here, Kelly, is that in 2023, the story was about organic growth. So this was the senior housing sector had lost a significant amount of occupancy during the pandemic. And through recovering that occupancy, Well was able to grow organically 14 to 15% this year. We still think as you go into next year, you still have 8 to 10% organic growth in front of you. But what I think drive the outperformance in 2024 is actually going to be their ability to do acquisitions. In October, they did $3 billion worth of deals just in 1 month.
Wow.
There's a lot of private investors, institutional investors that are looking for liquidity. And given that Well has actually delevered through growth over the last 12 months, we think they're very well positioned to have sort of both engines firing as you go into 24.
Yeah, don't let Lena Khan here. You know, she go, wait a minute, 3 acquisitions in a month. You also like Prologis, which is interesting. This one is still up about 15% year to date. Both of these you call kind of defensive growth. Is that right? Why stick with Prologis?
Yeah. So the industrial story, there's a secular story of online delivery, and industrials is the infrastructure for e-commerce. Prologis is the largest REIT in the index. They're also the largest industrial company, and they have the best sort of last mile infill portfolio. The reason we think it's worth sticking with Prologis is because they've guided to about 10% growth for the next 2 to 3 years, which is again going to be 2 to 3 times the rest of the REIT index. And you're getting that with a great balance sheet and a great management team. So the reason we think these sort of names are defensive is because even if the economy slows down or worse, these are names where the demand function can work even in a slower backdrop.